Malaysia and Indonesia are rapidly advancing in the Southeast Asian economy, but what drives their continued success?
The answer is the financial sector. Financial sector is not just about the money. It also helps our economy grow steadily. In Malaysia and Indonesia, this sector is crucial for ensuring continuous economic growth. The state of the financial sector in Malaysia and Indonesia is determined by several factors, such as the overnight policy rate, OPR, gross domestic product (GDP), and monthly and annual interest rates.
Interest rates in Malaysia are important to be used by Bank Negara Malaysia (BNM) to control the economy. This interest rate determines the cost of borrowing and the rate of return on savings. In April 2024, Bank Negara Malaysia maintains the interest rates at 3%.
The values of currencies, especially the Malaysian ringgit, is directly affected by interest rate. When interest rates rise, it usually attracts more foreign investment, or FDI, the foreign direct investment. Because of the higher returns, it will cause the currency to appreciate. Let's see in 2023, when Bank Negara Malaysia raises interest rate to deal with inflation, the value of ringgit continues to strengthen against the US dollar. However, in periods of world instability such as geopolitical conflicts or economic crisis, currency values can be affected even if interest rates are raised.
How do interest rates or currency value affect the daily life of people in Malaysia? First, higher interest rates mean higher borrowing. On the other hand, higher interest rates also benefit savers because they will get better returns from their savings.
In April 2024, Bank Indonesia raised its key interest rate to 6.25%. This marks the first rate hike of the year. According to RHB Investment Bank, this is likely to be the last increase unless there is additional external pressure. One of the main reasons for this increase is to control inflation, which can adversely affect the economy. Bank Indonesia aims to keep inflation within the range of 1.5% to 3.5% for 2024. By maintaining higher interest rates, the bank can curb excessive demand, thereby stabilizing the price of goods and services.
Higher interest rates make personal, housing, and business loans more expensive. This reduces consumers' ability to spend and invest, which can ultimately slow economic growth. Early in 2024, the rupiah depreciated by 2.3% against the US dollar. By raising interest rates, Bank Indonesia aims to attract more foreign investment to support the currency's value. Interest rates and currency exchange rates are closely connected in the global economy. When interest rates change, they can influence currency exchange rate due to the interest rate differential.
The currency exchange rate within 1 year. Investors often move their capital to countries with higher interest rate to achieve greater returns, increasing the demand for that country's currency and consequently boosting its value. For example, if a country's interest rate is higher than another's, investors may transfer their investment to the higher rate country. This shift can reduce demand for the lower rate country's natural resources and drive up prices.
This diagram illustrates the currency values of Malaysia and Indonesia over a year, from May 2023 to May 2024. Currently, the Malaysia currency is valued at RM1 Malaysia equals 3,404.27 rupiah, while 1,000 rupiah is equivalent to RM 0.29 cents. This indicates that the interest rates in Malaysia have increased compared to those in Indonesia. With concerted efforts, Malaysia and Indonesia have built a strong foundation to navigate globalization. The financial sector not only aids in continuous economic growth, but also ensures our country progress forward, stepping together towards economic growth in Malaysia and Indonesia.
Primarily by price increases. He said inflation will hover within 3% to 3.5% this year, up from 2.5% in 2023, prompting the central bank to keep the rate steady. Economist Yaki Len said the fuel subsidy rationalization and increase in tariffs on various essentials will push the consumer price index up to 3% this year. Yet, an economics professor at SEFB Business School said it is unlikely for the PPR to fall below 3% this year unless inflation remains at a below the trend line for a prolonged period of time. Data from the Statistics Department shows that the inflation rate was 1.5% and core inflation was 1.9% in December 2023. The annual inflation rate was 2.5%, down from 3.3% in 2022. Afin Kwang Investment Bank Chief Economist Alan Hunt also expects the central bank to maintain the OPR at its current rate, but he expects the inflation rate to rise as high as 3.5%.
A comparison of quarterly interest rates in Indonesia and Malaysia from Q2 2023 to Q2 2024, showing stability in Malaysia's rate and incremental adjustments in Indonesia's rate. The quarterly interest rates of Indonesia and Malaysia from Q2 2023 to Q2 2024. Indonesia's interest rate remained at 5.75% from Q2 2023 to Q1 2024, then increased to 6.25% in Q2 2024. Malaysia's maintained a consistent 3.00% interest rate throughout the specified quarters. The data highlights the stability in Malaysia's interest rate compared to the incremental adjustment in Indonesia's rate. This comparison provides insights into the monetary policy decisions and economic strategies of both countries during the specified time frame. Quarterly GDP growth rates Indonesia Q1 2023 5.04%, Q2 2023 5.17%, Q3 2023 4.94%, Q4 2023 5.04%, Q1 2024 5.11%.
In conclusion, the financial sectors of Malaysia and Indonesia are essential drivers of the economy. Through the strategic interest rate adjustments and currency value management, both countries have shown resilience and adaptability. Malaysia's stable interest rates have provided consistency, while Indonesia's rate hikes have targeted inflation control and currency support. These efforts highlight the commitment of both nations to sustainable economic progress.